Good morning, sir.
Good morning.
Everyone, make sure you have login with your registration number. So Zoom login name should be your registration number. Otherwise, your attendance will not be counted. So let's start now. So you can remember last time we were discussing on analysis of assets. Analysis of companies' investing activities. So, investing activities. You know, investing activities results in assets. Investing activities results in assets. So we have analyzed property, plant and equipment, inventory, trade receivables, and cash. Cash. So if you look at trading, manufacturing businesses, service businesses, so these are operating assets. These are usually operating assets. Operating assets. Right. Now we have studied analysis of these assets. So our aim is to ensure these assets are recorded at appropriate values. So in the accounting analysis, what we do is we check whether the assets are recorded at the appropriate values. So when they are not recorded at the appropriate values, you do some adjustments. So we studied some adjustments relating to these assets. Okay. Then the second category of assets is financial assets. Now this is what we are going to discuss. in the today's session, financial assets. In addition to operating assets, company can have financial assets. Financial assets. Those are investments. Investments. Investments in debt securities and equity securities. So you have studied debt and equity securities in financial management. Now you have the idea. You have studied that. Calculation of intrinsic price of debts, bonds, debentures, and intrinsic price of equity securities, ordinary shares. So you have studied that. Now you have the knowledge. Now we are going to see how these financial investments should be measured at the financial statement. So we are going to see how to check whether these financial assets values are appropriate in our analysis. Now, in the present context, for financial assets in Sri Lankan context, for measuring financial assets, we have SLFRS 9. SLFRS 9. Now, you should have studied. So, to study an accounting standard, it should not necessarily be in your syllabus. Right. So by the time of your graduation, you should have studied almost all the accounting standards. They should not be necessarily in the syllabus. Because when you go to the industry, during the practical training, when you are doing a job in this field, so you should know accounting standards. Without knowing that, you have no value. You have no value in the industry. Even you see in the present context, you cannot pass any interview without knowing accounting standards. Right. Now, if you haven't studied SLFRS 9, so it's time to study. Right. So we have in the present context SLFRS 9 for financial assets. So in the international context, IFRS 9. IFRS 9. So if the company has applied IFRS 9 or SLFRS 9, then you are confident that the financial assets values are appropriate for your analysis. Then you don't have to worry about that. Because this SLFRS 9 or IFRS 9, according to this IFRS 9 or SLFRS 9, you try to record fair value. So the standard insists recording fair value of financial assets. So if the company has applied this accounting standard, IFRS 9, then you don't have to worry about financial assets values. Right. Now we'll have a little bit discussion about these financial assets and how IFRS 9 can be used to measure different financial assets values. Yeah. So mainly financial assets, two types. So I'm not going to discuss the accounting standard. So I'm going to just take the measurement part, only the measurement part. So financial assets, you can categorize debt instruments and equity instruments. Debt and equity instruments. So company can have investments in debts like debentures, So debentures are debt instruments, or bonds, and company, you can see under investments, investment in fixed deposits, Then under equity instruments, you see investment in equity shares, right? So these are just examples of different financial assets. Right. Now let's see about debts. Right. Debt instruments. Right. Debt instruments. So there can be different purposes of investing debt instruments. The company may have different purposes. For example, company invest in debt instrument to keep those assets for a particular time period to receive cash flows. We call contractual cash flows. Let's say company invest in a 5-year debentures. The purpose is to keep the investment for 5 years to receive contractual cash flows. Now, what are the contractual cash flows? For example, investment in debentures. Let's say 5-year debentures. So contractual cash flows are year 1, year 2, year 3, year 4, year 5. You receive interest. So you receive periodic interest coupon. Then at the end of at the maturity, you receive the capital. You receive the nominal value. At the maturity, you receive the nominal value. So this could be one purpose. You invest in debt securities to receive contractual cash flows. Your cash flows are periodic interest plus the maturity value, the nominal value you receive at the maturity. And on the other extreme, the purpose of investment in this instrument is for sale. The purpose could be for sale. Held for sale. So you invest in debt instruments for the purpose of selling. For the purpose of selling and getting quick profits. So if you can invest at lower price, then if you expect after a particular time period the price goes up, so you invest at lower price. When the price goes up, you sell. Now you see, purpose is selling. So these are the two extremes purposes you can have. The company can have. The company can hold debt instruments for contractual cash flows, and the other is the company can hold financial instruments, debt instrument, for the purpose of selling. Now you see, held for contractual cash flows and held for sale. But practically, company may have both objectives. Part of the debt instruments are held for receiving contractual cash flows, and there's another part of the instrument held for sale. Right. So company may have both. A part for contractual cash flows and the balance held for sale. For example, you invest in debentures. So part of the debentures you hold for contractual cash flows, for receiving contractual cash. And the balance part of the investment debentures you hold for selling purpose. Now, depending on your business model, these are your different business models for debt instruments. So depending on the business model, the measurements vary. According to SLFRS 9. So depending on this business model, the way you measure your debt instruments varies. So if you have studied SLFRS 9 before, you know this. Right. Now we'll take simple example. Now assume, very simple example. Assume you invest in 10% debentures. You invest in 10% debentures. At a price of rupees 1080. So today you invest 1080. Then let's say debentures mature in 5 years. Debentures mature in 5 years. Nominal value rupees 1000. So one debenture nominal value 1000. Right. Now you see, assume you expect to hold this investment to receive contractual cash flows. Assume this is your business model. Assume the purpose of this investment is to receive contractual cash flows. Contractual cash flows. Now, what are the contractual cash flows? So today invest, let's say coupon paid annually. So you have coupon for 5 years. Coupon for 5 years. Coupon at 10%. Nominal value 1000. Then you see coupon 100 each. Coupon is 100 each. Then at the maturity, you receive the par value. At the maturity, you receive the par value. So your intention is to receive these contractual cash flows. Now, if you look at accounting part, so if the company intends to receive contractual cash flows, so this investment should be recorded at amortized cost. This investment has to be recorded at amortized cost. Amortized cost at the effective interest rate. Now, this is according to SLFRS 9. So you should have studied. Now, how do you find the amortized cost? You have to find the effective interest rate. So that's very simple. You can apply Excel. You can apply spreadsheet to calculate the effective interest. Right, now let's see that. So let's see the calculation. So we have contractual cash flows. So year 100, year 2, 3, 4, 5. First 4 years 100. Then at the maturity, you receive 1000 plus 50 year interest 100, 1100. In the 5th year, you receive 1,100. So today your investment, so you buy debentures at 1,080. You buy debentures at 1,080. Right. So these are contractual cash flows. You invest today at 1,080 to receive these contractual cash flows. Now you have to find the effective interest. So what you can do is you can simply calculate IRR. You can simply calculate IRR. IRR. So these are the values. So IRR 8%. IRR 8%. So this is effective interest. Effective interest rate. Effective interest rate. Now, based on the effective interest rate, you can account the, or you can do the accounting. Now, your coupon or interest income, you have to account at the effective interest rate. Right. So let's prepare the amortization schedule. Right. So you can have at the beginning, value at the beginning, coupon, interest, coupon received, and value at the end, investment value at the end. Right. So the purpose of this table is to find out how much interest you take to the profit each year. So today you invest at 1,080. That's the fair value. So fair value of one debenture is 1,080 today because you invest at 1,080. Transaction price is 1,080. That's a fair value. Then the interest equal is beginning balance multiplied by effective interest rate. This beginning balance multiplied by effective interest rate. Right. So first year, so let's say this is year one. So year one, you have to record interest income of 86. But you receive contractual cash flow for year one, you see 100. You receive 100. Then how much investment value at the end? Beginning plus interest minus coupon received. Beginning balance plus interest minus coupon received, cash flow received, you get the end value. So end of the year one investment value is 1066. This end value is value at the beginning of the next year. Then next year interest, this beginning balance multiplied by effective interest rate. Beginning balance multiplied by effective interest rate. Right. So beginning balance multiplied by effective interest rate, 8%. Right. So you can fix this value. B9 effective interest rate, you can fix F4. Right. Then you see for the second year, contractual cash flow receive 100. So coupon receive is 100. So let's say cash flow received 100 for the second year. Then end value, beginning balance plus interest minus cash flow received. Cash flow received, you get the end value. So likewise, you can calculate for the rest of the years. You can calculate for the rest of the years. So last year contractual cash flow 1100. Now you see at the end you get 0. At the end, investment value 0. Right. So first year you have to record interest 86. Then first year investment value, end of the first year investment value 1066. Second year you have to record interest 85. So 85 goes to profit and loss. Then in your statement of financial position, investment value at 1052. So this 1052 is amortized cost. Right. So these end investment values are at amortized cost. Amortized cost. You see again first year. First year. You see again first year. You take 86 to profit and loss. You take 86 to profit and loss. Then investment value at the end of the first year 1066. 1066. So this is at amortized cost. This is at amortized cost. Amortized cost. Amortized cost. Right. So logically, their meaning is the present value of future cash flows. So amortized cost is logically its present value of future cash flows. Now, if you come to the first year in, what are the future cash flows? Second year 100, third year 100, fourth year 100, and fifth year 1100. So you get the present value of these future cash flows. Now, when you come to the end of the first year, the future cash flows are Second year 100. Third year 100. Now when you come to the end of the first year, future cash flows are now we are at the end of the first year. Future cash flows are so we have 4 years cash flows. The next 4 years cash flows. In the next year, you get 100. In the following year, you get another 100. In 3 years' time, you get another 100. In 4 years' time, you get 1100. So future cash flows at the end of the year 1. These are future cash flows at the end of the first year. Now you are at the end of the first year. So you have cash flows over the next 4 years. So in the next year, 100. In 2 years' time, another 100. In 3 years' time, another 100. And in 4 years' time, 1100. Now you get the present value of these cash flows at the effective interest. You get the present value of these cash flows. Present value of these cash flows. Right. You get the total present value of these cash flows. So we can apply the NPV formula. So rate is 8%, 0.08, comma values. Values. How much? Net present value. You see 1066. 1066. That equals to the investment value. That's equal to the investment value. Right. Now you see, this accounting method reflects investments are recorded at the fair value. As I am telling you, if the company applies IFRS 9, then you are confident that the investments are recorded at the fair value. Right. Now you see, you record in the first year end, at the end of the first year, investment at 1066. That's equal to the present value of future cash flows. Present value of future cash flows. So this is a fair value of the investment. Present value of future cash flows is the fair value of the investment. Right. So this is a very simple example. Right. So you can understand only if you have learned IFRS 9 or SLFRS 9. If you haven't done that, it's time to read that standard. Now you see, so if the purpose of investment is to help for contractual cash flows, then it should be recorded at amortized cost. It should be recorded at amortized cost. Amortized cost. Right. So amortized cost, it's equal to present value of future contractual cash flows. Amortized cost is equal to present value of future contractual cash flows. Then you feel the investment is recorded at the fair value. Fair value. Right. Now let's see another simple example. Let's say you have invested in a fixed deposit. Let's say you have invested in fixed deposit. On 1st April 2021, APLC invested in a 4-year fixed deposit. Rupees, let's say 10 million. The interest is paid annually. At the rate of let's say 9%. At the rate of 9%. Now let's say your intention is to keep the investment. Let's say your business model is to hold the investment for contractual cash flows. That's your purpose. You keep the investment to earn contractual cash flows, to receive contractual cash flows. Right. Now, what are your cash flows? You invest today 10 million. So you receive cash flows over 4 years. In the first year, you have interest, 9% of 10 million. 9% of 10 million. Second year, you have interest, again 9% of 10 million. So likewise, you have interest receipts. So contractual one cash flow, interest receipts, 900,000, 900,000. So we'll see in thousands, contractual cash flows, 900,000. In the fourth year, you receive interest 900,000, and your deposit is matured. Your deposit is matured. So maturity value in thousands, 10,000. Now these are contractual cash flows. Contractual cash flows. Now let's see the accounting. So you have to account at the amortized cost. amortized cost. Right. So let's see now. Here, cash flow. So year one, you invested in 1st April 2020. You invested in a fixed deposit 1st April 2021. Then first year is 2021-22. Second year 22-23. Third year 23-24. And the fourth year 24-25. Right. So these are the years. The investment is today. That's 1st April 2021. Right. So we'll take in thousands. So let's say now you invested 10,000. You invested 10,000 in a fixed deposit. Cash flows, first year 900, second year 900, third year 900, fourth year 900 plus 10,000, 10,900. So these are contractual cash flows. Then you have to find the effective interest rate. Effective interest rate. So simply you calculate IRR. IRR. You see 9%. That's same as the interest rate. Effective interest rate 9%. Right. Then based on the effective interest rate, so you can do this calculation and find out how much investment value at the end of each year. Right. So remember, if the company's purpose is to keep the investment to receive contractual cash flows, you have to calculate the investment at amortized cost. Investment value is at amortized cost. Right. So logically, that's equal to present value of contractual cash flows. Present value of future contractual cash flows. So that's again fair value of the investment. Fair value of the investment. Practically, you find another example, zero coupon bond. You have studied in financial management. Right. Zero coupon bond. Now let's say you have invested today. So let's take another example. Example 3. Your company has invested on 1st April 2021 rupees, let's say 10 million in zero coupon bond. Let's say bond mature in 5 years. At the maturity value of 12 million. You know, in the zero coupon bond, you don't get periodic interest. You don't get periodic interest. So you invest today, then at the maturity, you get the maturity value. Now you see, you have invested 10 million today. In 5 years' time, your investment value is 12 million. So you don't have periodic interest. Now here also, the purpose, let's say, you hold this investment to receive contractual cash flow. Let's say company's purpose is to hold the investment for contractual cash flows. Now contractual cash flow. Let's see contractual cash flow. You invest today. The bond mature in 5 years. There is no periodic coupon. There is no periodic coupon, only maturity value. Maturity value 12 million. So maturity value is 12 million. Now you see, you have only one cash flow. You will get 12 million in 5 years. Right. You will get 12 million in 5 years. Right. Now let's see how this is accounted or how this is measured at the financial position. Right. Now let's take cash flows in millions, cash flows in rupees, millions. Right. So today you invest 10 million. In 5 years, at the end of 2025-26, you receive 12 million. You receive 20 million. Sorry, 12 million. Right. Now you have to calculate effective interest. Now every time, if the purpose of investment is to hold for contractual cash flows, If the purpose is to keep the investment to receive contractual cash flows, you have to value the investment at the amortized cost. For that, you need effective interest rate. So it's simply IRR, right? So these are the values. You get IRR 4%. So here you get IRR, right? 3.71. 3.71. So it's 4%, 3.71. Right. Now we can prepare this amortization table. So we can prepare this amortization table to calculate investment value at the end of each year. Right. So you can try. So value of the investment today 10,000, in millions 10 million. Then interest equal beginning balance multiplied by effective interest rate. Beginning balance multiplied by effective interest rate. So all these values are in millions. So let's take up to 2 decimals. So first year you have to record interest 0.37 million. Then 0.37 million goes to profit and loss. 0.37 million goes to profit and loss. Cash flow receives 0. Because in the first year, you don't get any cash flow. You receive cash flow at the last year, 2025-26. You receive 12 million in 2025-26. First 4 years, you don't get anything because this is 0 coupon bond. Then value at the end, beginning balance, last interest minus cash flow received. Then investment value at the end, 10.37 million. 10.37 million. Now, what is this 10.37 million? According to SLFRS 9, we call it amortized cost. But logically, this is present value of future cash flows. According to the accounting standard, 10.37 million is at amortized cost. So it's equal present value of future cash flows. Now let's see that. Now what are the future cash flows? We are at the end of the first year. So our cash flow is in 4 years. We are at the end of the first year. Next year, we don't have a cash flow. In 2 years' time, we don't have a cash flow. In 3 years' time, we don't have a cash flow. We have a cash flow in 4 years' time. We have a cash flow in 4 years' time. In 4 years' time, company receives 12 billion. In 4 years' time, company receives 12 million. Then how much today's value of this 12 million? How much today's value of this 12 million? So it's a simple present value calculation. You can use PV function. PV function. Right. Or you can discount this 12 million by the effective interest rate. Effective interest rate. Right. Then how much today's value of this 12 million? 12 million. So you discount this 12 million by this effective interest rate. 12 million is in 4 years' time. 12 million is in 4 years' time. So what you can do is you calculate present value interest factor at 3.71 rate. 1 divided by 1 plus R. 1 plus R. R is 3.71 to the power 4. Because this is in 4 years' time. This is in 4 years' time. 1 divided by 1 plus R to the power 4. So present value interest factor interest factor, you see 0.864 multiplied by 12 million. 12 million multiplied by present value interest factor. You see, you get 10.37. So if you take up to 2 decimals, this is 10.37. 10.37. Now you see logically that amortized costs represent present value of future cash flows. Right. So it's present value of future cash flows. Therefore, the investment is at the fair value. Investment is at the fair value. Right. Now what we did was, we got the present value of future cash flows. If you look at the last example, in the last example, we have cash flows all over the rest of the 4 years. You see periodic interest plus maturity value. But here 0 coupon bond. Then from the first year in, if you look at the next 4 years, you don't have coupon. You don't receive any coupon. Only the maturity value. Only the maturity value. So we have simply got the present value of this maturity value. It's a simple present value calculation. You have studied in cost management accounting, financial management. Cash flow multiplied by discount factor. So discount factor is 0.864 multiplied by cash flow 12 million. Then you get a present value of this cash flow 10.37. So you see the amortized cost, that's the learning point. Amortized cost represents the present value of future cash flows. Therefore, if the investments are recorded at the amortized cost, that indicates present value of future cash flows. Therefore, investment is at fair value. Investment is at fair value. So if the company applies IFRS 9, if it is Sri Lankan company, if it applies SLFRS 9, then you don't have to worry about the investment value. It is at appropriate value. So investment value is suitable for your analysis. Right. Now let's see. Now we have looked at the debt instruments held for contractual cash flows. Right. Now we'll see investments held for sale. So according to IFRS 9, if the investment held for contractual cash flows, you have to record that amortized cost. So if the investment is held for sale, then you have to record that fair value through a profit and loss. So you have to record that fair value. Any differences, you need to charge to profit and loss. Right. Now you see, if the investment is held for contractual cash flows, again, investments are valued at fair value. Sorry, if the investment held for sale, you see a investment is recorded at fair value. Investment is recorded at fair value. So that's I'm telling you, if the company applies IFRS 9, then you don't have to worry about the investment value. Because investment value is recorded at fair value. Right. Now let's see a simple example. Now assume on 1st April 2021, your company invested, let's say APLC invested debentures of XPLC at rupees 107 each. Let's say a nominal value. Nominal value is 100 each. Coupon is at 10%. And let's say a market value of debentures market value of a debenture as at the end of the year, that is 31st March 2022, is rupees 110. 110. Let's say this company invested 10,000 debentures. 10,000 debentures. Right. So on 1st January, APLC invested on 10,000 debentures of XPLC at 107 each, nominal value 100, coupon is 10%. The market value of a debenture as at the end of the year, 110. Assume the company's purpose of the investment is for selling. Assume company hold the investment for selling. Company hold the investment for selling. Then you have to record at fair value. Investment is recorded at fair value. Right. Now you see at the time of investment, fair value 107. This is fair value at the time of investment on 1st April. Now, if you see the accounting entries, at the time of investment, you record at 107. So your investment account debit, your investment account debit, investment account debit at 107 on 1st April 2021. Investment account debit at 107. You have invested in 10,000 debentures. 107 multiplied by 10,000, 1,070,000. 1,070,000. Then at the end of the year, fair value 110. At the end of the year, fair value 110. Then you have to value these debentures at 110 at the end of the year. So we have 10,000 debentures. Assume during the year you haven't sold any. Your purpose is for selling. You invested in debentures. Your purpose is for selling. But during the year, let's say you haven't sold anything. Then you have 10,000 debentures. How much fair value at the end? 10,000 multiplied by 110. 10,000 multiplied by 110. So that comes to 1,100,000. 1,100,000. Now you see fair value increase. You see fair value increase from 1,070 to 1,100. 1,070,000 to 1,100,000. You see fair value increased by 30,000. Fair value increases by 30,000. So that 30,000 goes to profit and loss. 30,000 goes to profit and loss. Then in your statement of financial position, investment value 1,100,000. So it's fair value. It's fair value. Now you see, if the company applies IFRS 9, your investments are at the fair value. That's your learning point, right? Your investments are at the fair value, right? So that amortized cost also reflect the fair value. That amortized cost also reflect the fair value, present value of future cash flows. Present value of future cash flows. Then let's see this category. Some investments you have held for contractual cash flows, and balance you have held for sale. That's a combination of these two. So part of your investment is for contractual cash flows, and the balance is for sale. So if this is the case, IFRS 9 says it should be measured at fair value. Should be measured at fair value through statement of other comprehensive income, not profit and loss, other comprehensive income, right? So this is according to IFRS 9 or SLFRS 9. Now you see again, it's fair value. Fair value. Now in the accounting analysis, so this is a key take today, your key learning point. So if you see in your statement of financial position and assets, investment in financial assets, now we have discussed, sorry, only one type of financial assets, debt instruments. So we have another type, equity instrument. Now, if your company has invested in debt instruments, you see that in a statement of financial position and assets. So if the company has applied IFRS 9, then you see investments are recorded at fair value. So whatever the business model, so one business model is, so you maintain the investment to receive contractual cash flows. Another business model, you keep the investment for sale. Another model is part of your investment for contractual cash flows. The balance part is for sale. So whatever the business model you see, investments are recorded at fair value. So this amortized cost is also equal to present value of future cash flows. Sorry. So this is also a fair value. Fair value. You see, the company applies IFRS 9, you don't have to worry about. You don't have to worry about the investment value because your investment at the fair value. So you don't need any adjustment. But if the company doesn't apply IFRS 9 or SLFRS 9, then you have to do adjustment to bring the fair value in your investment. So you can check the accounting policies. So if you feel that by checking the accounting policies of this investment, so if you see that company has not applied IFRS 9, then you have to look at that because the investment may not be at fair value. Then you have to do adjustments to bring the fair value into your investment. So simply you apply IFRS 9 and bring the investment to fair value. So that's what you are doing. So that's your learning point. So when you analyze investments, see whether they are at fair value. If not, you follow the guideline in IFRS 9, then bring the investment value to fair value. You bring the investment value to fair value. So that's about that's about debt instruments. So if you have any question, you can ask. Now, if you haven't studied SLFRS 9, so you have to do that. You have to do that. So if you have any question, you can ask. Right. Now let's see equity instruments. That's investment in shares. Investment in shares. Equity shares. There are situations. These investments are kept for contractual cash flows. Sorry, kept for cash flows. Sorry. There are situations these investments are kept for selling purpose. Selling purpose. Right. So you can say sometimes equity instruments are held for sale, not held for sale. So your intention is not for selling. For example, let's say you invest in subsidiary. You invest in subsidiary. Our purpose is to support your operations. So that can be one situation. Right. Let's see a practical situation. Now, let's say your company is manufacturing paints. Your company is a manufacturer. So you manufacture those paint products and sell to distributors, let's say wholesalers. Then they are the ones who sell to end consumers. Now assume you wanted to expand the business. So what you do is, so you acquire one of your distributors. Let's say main distributor is APLC. Let's say your main distributor is APLC. So you invest in APLC. Then your purpose is to get the support of APLC because now it's part of your business, your subsidiary. Then you can have control over APLC. You can control APLC. Then you can do your business better than before. Right, because you can have control over APLC, your distributor. So you invest in APLC. You invest in APLC. Now you don't need to sell products to APLC because your distributor is part of your business, your subsidiary. Now you see the purpose of investment. So you haven't held the investment for sale. So your intention is to keep the investment for a long time. This investment is not for sale. You know, when you acquire APLC, you buy more than 50% of equity shares. Then you have equity share investment. Now you see, purpose of the investment is not for sale. So your intention is to keep the investment for a long time and to get the support of the distributing company. So with that investment, you expect your businesses improve, businesses will be expanded. So that's your purpose. Now you see, This investment is not held for sale. Is not held for sale. Right. So IFRS 9 says, so if the investment is not held for sale, you have to value at fair value. You have to measure at fair value through other comprehensive income. Through other comprehensive income. So if the equity investment is held for sale, IFRS 9 says you have to value at fair value through profit and loss. Fair value through profit and loss. Now you see, if the company applies IFRS 9, you see investments are at fair value. Equity investments are at fair value. So if the company doesn't apply IFRS 9, then you have to see whether investments are recorded at fair value. If not, you have to do the adjustment. You have to do the adjustments according to IFRS 9. So this is the key takeaway of this lesson. So today we studied about financial assets. Those are investment in equity instruments and debt instruments. So for financial assets, we have SLFRS 9 or IFRS 9. So you see whether you see the accounting policies of the company and check whether your selected company follows IFRS 9. So if it follows IFRS 9, then you have a confidence that the investments are at fair value. If not, you have to adjust the investment to fair value. You have to adjust investment to fair value. So you can follow guidelines given in IFRS 9. Right. So that's so what I have planned in today's discussion. Right. So now it's time to study IFRS 9 if you haven't done it before. Right. So you can download the standard. You can listen to a YouTube videos. Now in today's environment, the learning is very simple. You don't have to read the standard from beginning to the end. You can watch on YouTube. Right. So it's sometime 20 minutes, 30 minutes, short video. So with that video, you can get a basic understanding. Then you can read the standards and so to get a detailed understanding. Right. So you have to do it. Right. So not knowing the standards. So if you do not know the standards, then you don't have any value in the industry. right? So therefore, if you haven't done that, then you have to start now. So we have now completed our analysis of investing activities. So you can remember the purpose. The purpose is to see whether assets are recorded at appropriate values. Right. So we have analyzed investments in operating assets, property, plant and equipment, investment, trade receivables. So remember, trade receivable is also financial asset. According to IFRS 9, it's also financial asset. But here we consider it as operating because it's part of our day-to-day operations. Trade receivables are part of our operating cycle, part of the business operating cycle. Therefore, we have considered it as operating assets. So that's for our analysis purpose. But when you are doing accounting for trade receivables, so it's financial asset. Trade receivables are financial assets. But here we consider it as operating assets. Then we have studied financial assets. So investment in debt instruments and equity instruments. Right. Then our next topic is analysis of financing activities. So our next topic is analysis of financing activities. Analysis of financing activities. You know, financing as activities, companies' financing activities results in liabilities. Companies' financing activities results in liabilities. For example, when the company goes for a bank loan, then your liability is a bank loan. So if the company goes for a lease, let's say to buy a motor vehicle, then your liability is a lease liability. Many of these liabilities are financial liabilities. Many of these liabilities are financial liabilities. Many of these liabilities are financial liabilities. Bank loans, issue of debentures, financial liabilities. Trade creditors, a financial liability. So when you are doing accounting, you have to apply IFRS 9 or SLFRS 9. Right. So when you account for financial liabilities, you have to apply IFRS 9. in the Sri Lankan context, SLFRS 9. Right. So before the next class, you should have studied this. You should have studied IFRS 9 before the next lecture. Otherwise, you won't understand the things discussed in this lesson. So our next lesson is analysis of financing activities. So before the next lecture, you have to study IFRS 9. Right. So I'm not going to discuss this standard for financial liabilities because you have to study and come. So I'm doing only the analysis part. I'm going to do only the analysis part. Right. So this will be our plans for the next week. So next week we'll complete this lesson. Then we can move on to the third part of the accounting analysis of operating activities. Right. Any questions? Any questions? Right. Then see you next time.
Thank you, sir.
Thank you, sir.
You're welcome.
Thank you, sir.